Hello financial fans, welcome back to another stock analysis. Today we'll be covering STAG Industrial stock ticker STAG. STAG Industrial is a real estate investment trust, or REIT, that specializes in acquiring, owning and operating single-tenant industrial properties throughout the United States. The company's focus is on industrial properties that are used for warehouse and distribution purposes. STAG Industrial's strategy is to acquire high-quality properties that are leased to strong tenants with long-term leases. The company aims to generate stable and predictable rental income from these properties, which it can then use to pay dividends to its shareholders. STAG Industrial's portfolio consists of over 400 properties located in 38 states, with a total square footage of 92 million square feet. The properties are leased to a diverse group of tenants, including companies in the automotive, food, beverage, e-commerce, and manufacturing industries. The company is currently sitting at a market cap of $6.1 billion. And their revenue in 2022 was sitting at $657.4 million, and the dividend yield is currently sitting at 4.42%. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never be below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety can increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $36 million in 2013 to $178 million in 2022. The average EBIT growth is almost 62%, which gives them a margin of safety deduction of 10%. Margin during this time has also gone up, going from 16.4% to 27% in 2022. The average increase in margin during this period is 37.8%, which gives them another 5% deduction from a margin of safety. The next two ratios are the dividend growth and the debt to EBITDA ratio. The dividends have gone up over the years, going from $1.84 a share in 2015 to $1.96 a share in 2021. The average dividend growth is 0.8% only, which is a 5% increase in the margin of safety. The debt to EBITDA ratio is calculated as follows. We'll take the debt of the company and deduct it by the cash. All that's left to do then is to divide it by the EBITDA, which gives us the amount of years of EBITDA it takes for the company to pay off all of their debt. For STAG, this is just under 5 years, in this case a 472% debt to EBITDA ratio, which is a 5% increase in the margin of safety. The final two ratios are the occupancy rate and the rent reversion rate. The occupancy rate for STAG is sitting at 98.5%, meaning that those 98% or 98.5% of their properties are occupied, which gives them a 5% deduction and a margin of safety. The rent reversion rate is when a landlord raises the rent on a property when a lease is up for renewal to match current market rates. Basically meaning, are they making more rent out of their property over the years? In this case, yeah, they are actually making quite a bit more rent out of their properties, with a 5-year CAGR of 14.3%, which is another 5% deduction in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of STAG Industrial. The first model that we'll be using is the price to funds from operations ratio. I will be looking at the 5-year average price to funds from operations and comparing it to the trailing 12-month price to FFO. The average price to FFO of the past 5 years has been sitting at $20.69, while the trailing 12 months price to FFO has been sitting at $15.10. This gives them a value of this model of $46.33, which is almost a 37% upside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of STAG going from 2018 to 2022. The average growth rate during this period in their dividends has been 0.70%, and I'm projecting an expected growth rate in all of their future dividends of 1%. I will be using a discount rate of 9% in this valuation. This gives them a dividend discount model price per share of $24.58, which is a 27.33% downside out of this model. The third model that we'll be using is the AFFO multiple valuation. I will be looking at similar companies to STAG and look at their price to AFFO ratio. The average in the industry is then determined at 20.50, while the price to AFFO of STAG is sitting at 17.72. This gives them a intrinsic value of this model of $39.12, which is a 15.66% upside out of this model. And the last model that we'll be using is the net asset value. In this model, we'll take a look at the net operating income of STAG and projecting expected growth rate for the next year. And this way, we'll determine the forward year net operating income. And now we'll be looking at how much they can capitalize on this net operating income. I'm setting this at 2.5%, giving them a value of $9.2 billion. And then we just have to subtract the debt from it, and that gives us a net asset value of almost $6.7 billion. All we have to do then is to divide it by the shares outstanding, giving us a net asset value price per share of $37.31, which is a 10.32% upside out of this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the price to FFO, discounted dividend, AFFO multiples, and the net asset value price per share, giving us an average of $36.83. A margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 10% for the EBIT growth, 5% for the margin growth, adding 5% for the dividend growth and debt to EBITDA, and deducting another 5% for the occupancy rate and the rent reversion, giving us a 10% margin of safety. Applying this margin of safety, we get a fair value of $33.48, while the current price is sitting at $33.82. This means the upside is actually a downside of almost 1%, meaning that's very close to intrinsic value currently, indicating that's currently just a slight sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.